Hello and welcome to the Global View on this Tuesday. I'm Andrew Gagan. Good to have you with us here at AusBiz. Let's begin with what happened overnight as global markets got underway for the week negatively, in fact, with concerns over tariffs, seeing those equity markets weaken with oil prices continuing to fall at the same time. Now, on Wall Street, the S&P 500 snapped its longest run of gains in 20 years, while the Dow also broke a 9-session winning streak. As well as taking profits, investors considered President Trump's decision to slap a 100% tariff on movies produced outside of the United States. Netflix fell, having risen for the past 11 sessions, while Amazon and Paramount Global were also lower. The energy sector was the worst performer after OPEC Plus decided to hasten its output hikes. Ford suspended its annual guidance because of uncertainty around tariffs, saying the levies would cost the company around $1.5 billion in adjusted earnings before tax and interest. It reported after the close, with its shares down about 3%. Barbie maker Mattel withdrew its annual financial targets, saying it would increase prices for some products in the US to counter rising input costs due to the tariffs. It said it would accelerate plans to move production out of China. The toy maker's shares down around 2% in extended trade. Class B shares of Berkshire Hathaway fell after Warren Buffett announced that he'll step down as chief executive of the conglomerate. Tyson Foods shares took a hit after the meatpacker missed quarterly revenue expectations, and Skechers shares surged after the footwear maker agreed to be taken private by 3G Capital in a $9.4 billion deal. Well, US Treasury Secretary Scott Bessent has sought to reassure US markets, saying that they were anti-fragile and would weather any short-term turbulence, saying the primary components of the Trump economic agenda, trade, tax cuts and deregulation, are not standalone policies, saying they are interlocking parts of an engine designed to drive long-term investment in the American economy. Well, the latest US data shows a pickup in growth in the services sector last month as orders increased. That boosted a measure of prices paid by businesses for materials and services to the highest level in more than 2 years, signalling a build-up in inflation pressures due to tariffs. The ISM survey adding to solid job growth in April, offering assurance that the economy is not near a recession despite economic growth contracting in the first quarter. US Treasury yields have edged higher in response to the data. The US 2-year Treasury yield rising to 3.85, while the 10-year was up to 4.37, with markets pricing in a near zero chance that the Fed funds rate will be cut at this week's FOMC meeting. The US dollar has weakened against major currencies. The Aussie is up at 64.6 US cents, and Bitcoin trading at around 95,000 US dollars. Oil prices have fallen further, down more than to 4-year lows, in fact, as an OPEC Plus decision to bring forward its output hike stoked fears about rising global supply, just as demand outlook is looking uncertain. Brent crude futures down more than 1.5% to $60 a barrel. Copper was up 0.5%, iron ore rising close to 1.5% to $98 a tonne, and gold has gained, driven by a weaker dollar and safe haven demand ahead of policy decision from the US Federal Reserve. Spot gold up around 2.5% at $3,329 an ounce. So let's get across the markets from a US perspective. John Blank joining us from Zacks Investment Research. John, welcome back. Good to see you. What are you making of that data at the moment, obviously with the backdrop of, well, what we hear from the White House, ongoing negotiations with tariffs?
Andrew, let's throw out the year-to-date marks for everybody. Dow down 3% at this point, which is nothing. S&P down 4%, which is nothing. Nasdaq down 7.5%, which is something, and the Russell down close to 10%. So what that tells you is there's still a risk-off sentiment, and there's no bid on smaller companies, which means there's a low-growth environment. I think, basically markets are pricing forward and looking like they always do, but we have, what we already know, which is a minus 0.3% GDP growth rate for the first quarter, basically because imports were so huge because people were trying to beat the tariffs. And by beating the tariffs don't matter from a macroeconomic context for another few months, probably 3 months. So I think this is the kind of message the market's sending us, is that, yes, it's going to be a slowdown in growth, but we've bought ourselves some time with these imports up here. And that is basically keeping a market that's looking ahead not as far as people would like it to do.
When are they going to run down those inventories, though, John? With when are consumers going to notice that the shelves are looking empty?
I think we're going to have to watch the Los Angeles and Long Beach port information and the press releases that are coming out of there. As soon as there stops to be shipping that comes in there, or ships that are coming there, half loads, and we will find that out. They do produce that data. Once that starts hitting things, we're going to get media reports in from the big box retailers, and we're going to start to learn that, yes, indeed, people either A, don't have much selection, or B, they do have selection at much higher prices now. When that sticker shot hits, Andrew, we're going to know. For example, I was looking at Ford's releases, and a lot of their days of inventory are 140, 150 days in a lot of their models. So that tells you they can go, 3 months without having to put up an auto tariff on one of their vehicles. And so this is the situation out here. I think, we've got a kind of a pause that makes things seems like, oh, it didn't really matter kind of thing. And I think, news flow and then sticker shock in the summer, mid-summer, June, is when we're going to find out, Andrew.
Well, of course, this comes ahead of the Fed meeting this week. John, what do you think markets want to hear from Jerome Powell?
I noticed this morning that the bond market that moved most in the first quarter was the TIPS market. So they're going to want to know his view on inflation. I think, the view on unemployment is second to that at this point in time, because tariffs are really going to have a first initial effect in terms of prices. So I think the first thing they're going to want to know is how he's going to deal with tariffs, if he's going to use the language he used before, transitory, or whether he's not. And then they're going to try to feel him out and see whether he's going to give what Goldman thinks is the benchmark, which is a July 25 basis point hike, a SEP 25 basis point hike, and a December 25 basis point hike. So they're going to ask him about, if he's going to actually cut down, 75 basis points this year, like the market thinks.
Now, of course, that's what's going on in the States. China obviously also affected, given the massive 145% tariffs on their goods. And we do have a read on trade data in China this week as well.
Yeah, that's it. 145% on tariffs. The only thing that can be said that's somewhat sanguine, I think the number of imports from China to the United States is 500 some billion, which is on a 28 or 9 trillion dollar economy. It's it's in the small single digits in terms of the overall effect on the U.S. economy. So you got to hope that this particular segment of trade just does not register enough at the macroeconomic level to take the rest of the U.S. economy down. And that's the only bet that, that's a bullish bet. And, in terms of what the GDP mark is 0.8% of GDP from a 3% number to 2.2 or 1.0 or something like that. We'll see. It all depends on the retaliation. And it also depends on what Trump does with the 90-day expiration on all of the other 60 countries that he claims to ramp up at that point in time. So, it's going to be a weird battle between the 90-day deadline and the amount of imports that have been pulled into the country to see what actually plays out.
John, let's get to your 3 stock picks that you bring us every time you're on the show, which is great. Let's begin the first one there in the semi-space, Broadcom. Why are you looking at this?
Andrew, this is one I'm most bullish on. This is the number 1 ranked stock with a B for growth, and it means it's a strong growth stock. And it used to be priced at $240 a share back in January. Now you've got a price of $200 a share. So you've got a nice 10% pullback. Just like we talked about the Nasdaq giving you a 10% pullback, this stock is the classic stock, with the idea that if you get a 10% pullback broadly and this stock takes that heat along with the market, you've got to want estimate revisions going up. So this stock is worth more now than it used to be. And we're getting 5% upside revisions in 2025 and 5% upside revisions in 2026. So a name like this, we've got a target price of 220, but if the high is at 240, get a nice 10% move you can ride on this type of stock.
All right, that's Broadcom. Right. Second stock you're taking a look at is the French food processing company Danone. And are there any tariff implications for this company?
Well, you hit the nail on the head, Andrew. There's no question that this is a tariff stock because you got a $13 share price, Andrew, back in January. You got a $17 price now. So what this says is that, the EU is going to protect its agricultural goods. This is agricultural, staples types products. It's goods, and it's European goods. So it's got a domestic bid now if you get in a trade war with retaliation to the United States. And so there's no question, you hit the nail on the head, that Danone is basically a trade war stock at 17. The PE ratio, by the way, is 20 times earnings. They're only making 90 cents a share next year. So at a $17 a share stock, it's a pretty richly priced staple stock at this point, unless you do really get some growth out of European Union protection.
Thirdly, Centene. So this is what a diversified healthcare company.
Yeah, Centene's based in St. Louis, Andrew. They've got about 30 million subscribers of healthcare HMO plans. So that's 10% of the United States population, or thereabouts. And so what is interesting here is this is another Trump trade that's not a tariff trade. It's a Medicaid spending cut budget trade, because it used to trade at $75 a share. Now I've got a price at $60 a share. And estimate revisions are getting cut 2 and 3%, down from where they were. They're still positive. It's still making $7.70 a share on a $60 share price. You still got an 8 times earning stock. So if you're a value investor, you got to love this stock. But if you have worries, and a lot of people do, that there's going to be a massive amount of spending reductions on Medicaid that flow through to HMOs like this, this is the bear case for stocks like Centene. And that's why I probably keep it in the third place of the 3 we talked about today.
And John, overall, how are you looking at those earnings results we're seeing out of Wall Street at the moment, particularly with a look at EPS?
Yeah, Andrew, the same thing I've spoken to in the show as I'll speak to again. The first quarter was really strong, actually double-digit earnings. Second quarter is looking fine with a 7 or 8% earnings growth. And so, again, we're talking about a stock market that for at least is telling us 1 and 2 of the 4 quarters this year are going to be just fine. And then everybody's pulling, their outlooks on the second half of the year, basically, because nobody really knows. I mean, you've got calls for 1% reductions in GDP growth as a consensus, but then you've got very valid, trade repression calls for a minus 4% knockdown on U.S. growth, which would take us into a recession. So, when you got 2 very different base cases, because nobody really knows what's going to happen by the end of the summer, we're going to have to be in a wait and see for the third quarter and fourth quarter.
John, always terrific to get across what you're seeing. Thanks for joining us from Zacks Investment Research.
You bet, Andrew.
Quick look at the local market, where we're likely to get going, looking for a negative start. That's off the back, of course, those falls we saw yesterday with SPI futures off around 0.25%. Stay with us. The open is a couple minutes away.